So now let's start to filter all of the macro discussion through trying to build equity. So let's start there.
Yeah, well, look, if I take out some of the key points that Eric just made here, if I think about, overall economic activity, right? It's okay. But what it does is it creates a pretty good backdrop for corporate earnings growth. He showed that K-shaped economy, right? And this is actually where you're seeing lots of money still being made. If we think about, the labor market, if that happens to slow down, the Fed actually has room to be accommodative here. So when I take that all in, I do think about that's actually a pretty supportive case for equities over the next year or two. And look, if I think about the risks, it's interesting in terms of how that survey feedback came back in terms of everybody seems to be concerned about the expense of the equity markets and the concentration in the equity markets. I do think that's a big risk, but here's where I think the breadth of the equity markets can really come into play here, because it's because of that concentration that you have a narrow set of companies that are very expensive. Other risks that we see is, and I think this is over a longer term, the inflation still is above that 2% level, right? And what that means is actually causes for a higher cost of capital than anything we saw over the past decade. And that's something that you really have to take into account. And then finally, there is just uncertainty around policy, around how tariffs are going to continue to play out, and also just in terms of how the macro is going to play out. And so I do think we need to be prepared for volatility.
And obviously, valuations are a big part of the conversation as well. I get asked about this all the time. If I could, just can I insert just a little general chit chat about AI at this point?
Sure.
I mean, it is impossible for me at least, and I'm sure for you, to go out into the world and talk about markets without having an AI discussion and what we call the Mag 7 versus 493 or whatever that is. So you touch every approach to equities, from across cap, across style, across region. So what's your overall, if you were talking to everybody that's on the line here, how do you sort of think and talk through the AI, and what are the conversations taking place on teams?
Yeah, look, I think if someone asks me, are we in an AI bubble? I want them to take a step back and realize that is way too simplistic of a question for a very, very complex answer. If you think about just the impact that AI CapEx has had across the entire economy, Eric showed this in terms of, you look at GDP growth, but then you exclude out GDP growth without the AI spending, right, or the technology spending. It is such a broad part of the economy now. And you can break out AI into different categories. First of all, you have to think about your enablers. Okay, these are the hyperscalers that have the companies that have been investing in creating the large language models. But in order to do that, you have to have a whole ecosystem to be able to do that. You start from as low level as energy, right? Because it takes energy to train those, to run those data centers that train the LLMs. You need power, you need transmission, you need the data centers, you need cooling, you need semiconductors, you need the connections for the semiconductors. You need all the semiconductor manufacturing. So it is a whole ecosystem, and it's way too complex to be able to say this entire thing is going to stop. Once you leave that, then you also have the beneficiaries of AI. And when you think about beneficiaries of AI, there's two sides to that equation too. There are the companies that can monetize the new products that they can create with AI, but then there are also the companies that are going to be disrupted by new AI technologies. Okay, and so when I talk to my teams, it really is helping them making sure that they understand how is AI impacting their business model. They're somewhere on that spectrum, and it's going to impact a lot of different sectors across the economy. But and we need to be aware of it. But you can't just say, is it a bubble or not?
So thank you. And so then by extension, now let me take this to portfolio construction, portfolio design, right? So clearly I run into every form of opinion on AI, but you're sort of talking a lot about broad portfolio design and maybe taking a bit of all off the table, and some of the opportunities exist in the areas that maybe aren't directly in the center of the storm of AI.
Look, I think the way we have to think about this is you have to think about how are companies investing in AI? What is the potential ROI on that investment that they can generate? What's their visibility? And they're also the history of being able to convert those technology investments into profitable outcomes. So it does take a company by company look in terms of understanding, does that company have the ability to generate profits off of that investment?
I'm staring at the slide. We all love to talk about quality.
Yeah.
Can we head to the slide here? Because this is quality is a discussion that we have, I know Nelson, you do, all the time. How do you define it, about the variance of those definitions, everything, but tell me how you're talking about quality.
Well, first of all, let me clear why we talk about quality so much, right? In order to deliver that earnings growth that can exceed inflation on a continuous basis, it's such an important anchor to our equity portfolios. When we talk about quality, we're talking about owning companies that can deliver superior earnings growth on a sustainable basis, consistently through that cycle. These companies tend to have proven profitability, strong free cash flows, lean balance sheets that they don't need to rely on leverage to generate more profitability, right? As you could see last year, though, last year was a really difficult year for this approach. What we saw was an unusually powerful rally that happened across the most speculative parts of the market. And we've seen this before. This generally was driven by the expectations of that first Fed rate cut. And actually, if you looked at the, I think it was the jobs print on August 1st, and we saw that weakening, that's when markets really took off, because that's when it cemented that it's actually still cutting rates.
But it also illustrates, what I was saying about next year, right? It isn't so much how much they cut, the hope that they will sustain markets for some time. Right?
That's right. Yeah. And so I would see this as it was a very speculative rally. But what wound up happening as a result of, by the end of the year, you saw that quality stocks underperformed that speculative growth cohort by as much as 15%. Right. And so definitely left managers who were investing in these kind of companies scratching their heads saying, oh, my God, did I get something wrong? But look, what our experience tells us is that this pattern doesn't persist. And invest in chasing these speculative growth companies is really not the right way of creating that long-term wealth. What you can see is over 30 years, by investing in those speculative growth stocks, they tend to underperform the market by about 400 basis points. If you're able to buy that quality company, that basket of quality companies, you can compound that over time, 300 basis points over the equity markets. And you're doing that with much less volatility. You can see that the annualized volatility of that quality cohort is at 4% less than that speculative growth cohort. So it's a really important part of our asset allocation. And we think that's, history tells us a very clear story of that.
I think the sequence of returns, something I talk about all the time, is the unsung hero of portfolio design. We focus a lot on the absolute return that gets generated, but the path of those returns in the behavior portfolio is also incredibly important. So for me, I talk a lot about quality and how we define it and how it behaves for that reason. The title itself kind of picks it up here. Not all stocks are expensive, and cheap does not mean dull. What do we mean?
Okay, well, look, I think when that question comes across in terms of we're worried about equity markets being expensive, I think what most people are thinking about is the S&P 500. And if you look at its valuations, you're looking at something that's over the last 30 years is about as expensive as we've ever seen on a price to forward earnings basis. Okay, but I think the second part of the question is really interesting too, because they're worried about how expensive the market is and how concentrated the market is. And I think that actually leads to, if you look, there's a lot of dispersion across the markets. And if we were just to do something very simple by looking at, say, the value index versus the growth index, and look at the valuation discount that you get from the value index, this is sitting at an all 15-year low. It hasn't been cheaper since the tech bubble, right? And so that tells you about the breadth of opportunities that are available outside of that very concentrated set within the U.S. markets. And if you look at here, there's a lot of earnings growth to be had that just hasn't been picked up. And here you can see in commercial aircraft, agriculture, healthcare is a really interesting one. Here is actually someplace where I think AI is primed to be a disruptive force within healthcare. just in terms of, if you think about both, they can innovate products, but as well as reduce costs in terms of how you reach customers.
I'll say my 2 cents. Value is an area that not only has lost all sort of active flows since the GFC, but there's only been a couple of years where passive had positive inflows into value. And just the mere notion that that's how flows have traveled. And meanwhile, back at the ranch, as I've talked about in past disruptors, the makeup of the value index has changed. The opportunities inside of the value index. You mentioned AI. There's stuff inside of AI. I'm thinking of form factor inside of small cap value, things like that, where we have it in the title, there's growth within value. And so this is one of those areas that, and there's some more, but let's stay on this idea of concentration, if we can.
Actually, so one thing I want to take up is, if you look at the U.S. markets, the headlines say that growth once again outperformed value in the U.S. But if you look outside of the U.S., what you could see is that value significantly outperformed growth. And I'm talking about tens of percentage points. And what then you saw in the fourth quarter in the U.S. was you also saw value starting to outperform growth. So again, I think it's important just to understand that there's not just one game in town, and you have to cast a wider net in terms of finding opportunities to find those high quality companies that can deliver that earnings growth and really avoid that concentration in the markets. So let's look at U.S. versus non-U.S. Okay. The U.S. markets, we talked about concentration. Over almost 50% of the market is in technology. Okay. And if you look at the top 10 names, and that's the pie chart to the right that we're showing, the top 10 names represent over 40% of the index. So if you're buying a passive index in the S&P 500, guess what? You're buying a growth index. But if you look outside of the U.S. and you look at EFA, there's just such a broader set of opportunities. Technology actually doesn't represent that large of a part. And if you look, it's financials, industrials, other companies, including consumer, that really represents the majority. And so you get access to a lot of different types of growth outside of the U.S. And then you look at the index, it's very well diversified. So one way of combating that concentration and valuation you're seeing in the U.S. is actually by going outside of the U.S.
And there are just, so I know you all can't see the questions coming in as I can, but there are multiple questions on international investing. So we didn't plant those. Those are inside of here. So this is clearly something that's front of mind for everybody. And so we just coinkadinkly happen to have some stuff on international. So
yeah, look, I think international is such an important allocation to your portfolios now, right? It always has been, but I think today you get two features out of it. We've always talked about diversification as an important part of non-U.S. investing. And that would be for volatility reduction. But you also get a broader set of returns outside of the U.S. If you just think about some of the catalysts that we're seeing, look at what happened in Europe. They committed, because the U.S. backed away from NATO, there's now a need for other countries throughout the world to step up and increase their defense spending, right? It's about, $1 trillion in Europe over the next 5 years that they've committed to. That actually has catalyzed significant amounts of earnings potential, not just in Europe, but also in Asia. And so there's corporate reform going on in Japan, there's corporate reform going on across parts of the emerging markets that all can benefit for increasing company profitability, right? So there's a lot of opportunities, but let me walk you through a couple of these things here. So first of all, that concentration in the US markets, that is having an impact on volatility. It is becoming a less and less diversified index. And as a result, one of the things that you see is that if you look at the relative volatility of US versus EFA, that's risen consistently over the last 5 years. And so now you can see that the US market no longer is that safe haven type of market, and it's more volatile. The other interesting thing is that in the US, we are priced for perfection. Okay. And one of the things that we as equity market portfolio managers do is we're betting on fundamentals. We want companies to beat their earnings estimates. And we're doing our research to beat their earnings estimate. If you look historically, when you actually have a company that then beats that earnings estimates, they typically deliver about 100 basis points of excess return. When you get it wrong, you get it typically goes down by about 200 basis points. So there's a little asymmetry, but if you get it right long enough, the times you generate some alpha. Last year, with this price, with the valuations, you could see that you beat earnings, you got nothing for it. You missed earnings, you got crushed for it, right? But outside of the U.S., if you look at IFA, you continue to have this pattern where you can generate positive alpha. So again, I think it's you just have more return potential outside of the U.S. And again, you have many different themes that are working across.
Yeah, I know. Most of the time when we're building portfolios, again, there's the idea of what do we think is going to perform, have the best performance, and everything else. But trying to create efficiencies in the design itself, asymmetries in return patterns, sequence of returns. I know this doesn't sound like the sexiest stuff in the world, but in portfolio design, when there are questions around concentration, level evaluations, this all starts to become a really big, important part of the design of the portfolio to defend, but there's also an alpha component. So, and in the research and my discussions with your teams as well, international is clearly one of those places. And another one that I just personally have loved to talk about for a long time is the uncertain world of low vol. So I appreciate you put this slide in. So if you could take this one away.
Sure. Look, I think it's actually more important than ever to have lower volatility stocks in your equity allocation. We're continuing to see volatility around policy. I mean, just yesterday, if you think about, just across two tweets, right? We got a tweet on, industrial ownership of housing, institutional ownership of housing, and a tweet across defense contractors. And that sent those stocks tumbling, right? So there still is a lot of policy volatility going on. And then you pair that with that unprecedented speculative growth rally. Where that's gotten us to is we see some of the most compelling valuations in the low volatility space that we've seen in the market for 15 years. But I would actually reinforce that being defensive is about actively searching for volatility, for opportunities that will protect on the downside. Okay, I think you need to look through that. To do that, you need to look through a lens of finding those high quality companies, doing your research to really understand the sources of earnings stability that the company has, ensuring that you're paying the right price for it. And when you're looking at this, these opportunities do evolve actively. If you look to the right, you can see that how our own approach to finding low volatility across the equity markets has shifted. First of all, one of the places that we found lower volatility, pretty surprising, is technology.
In technology,
right? And and actually, when you first say it, it's like, how is technology, low volatility? I always thought of that as a high beta sector, but you break it apart. First of all, see that technology really is across semis and hardware and software. In software, that actually you can understand that a little bit more. It's very asset light. You've got a lot of recurring revenues through subscription-based businesses. That works very well, but it had been very expensive. Software now has actually come down a lot because of the controversies of AI disrupting some of that. Okay, but we also are finding that healthcare staples are also becoming very, very attractively priced.
Thanks, sir. Look, so themes in here. One, you can see definitely there's a bit of a vol off the table element to all of this, but there's also clearly an alpha opportunity. Part of the reason this is in here is how often we're asked about investing outside of AI. And the reality is those are not necessarily exactly the same thing. It tends to be more of a, how do I diversify the portfolio? How can I get opportunities? How can I get away from maybe the most highly valued, most expensive parts of an index? And how do I defend to the downside if things go poorly? And so that's why you see so many of these things in here, because you can defend but still participate. And I think that's probably the theme throughout equities.
That's right. Yeah. Look, if just to wrap it up in terms of, as I think about the importance of equity allocations from here, we are battling with higher levels of inflation, right? So what we need to do here is we need to anchor our portfolio across higher quality companies. we need to be casting a wider net to find those opportunities, and then we need to be actively reducing volatility so they do pattern of performance can play through.